Good morning. So I've got some questions on forecasts and interest rates. For all of you, this question, do you believe your own forecast? And if not, what else is guiding monetary policy? I appreciate you've touched on some of the issues, but given the rising inflation rates and all that's happening, how much confidence should we have in the forecasts, and how much do you have?
I'm happy to start off. I'm sure the others will want to come in. So yes, I mean, look, it's the central case for us. And I think a key point, and let's go to energy prices for a moment, because it's a key point. The convention we use for forecasting, or for the forecast for energy prices, is that we use the first 6 months of the market and then we hold it constant thereafter. Now, actually, the first 6 months currently is quite flat, and I'll come back to that in a moment. So it's a reasonably flat profile. It comes off a little bit, and it's a reasonably flat profile. That's one view. Forecasting energy prices is inherently, challenging. Let me put it this way, and particularly in the current environment. So we did present an alternative forecast, or an alternative scenario, I should say. Sorry. Which took the market price of and this is particularly relevant to gas, and you'll see that in the MPR, and that showed inflation falling faster and actually going below target. Now, what do we, to your question, I mean, which one do we believe? Well, they're both relevant, and the way I think about it is this: we've got a central case. As we said, we've got two-sided risks. We've got an upside set of risks, which I would say really now come from two things. One, as we were discussing a few minutes ago, second round effects in wage and price setting. Unfortunately, I think we've also now got an upside risk on energy prices from worse things happening in Ukraine. We've got a downside risk going further out, which is if you like, is the alternative scenario, which has then energy prices. Energy prices, as Ben has said to us many times, do tend to revert to mean eventually, and the market takes it towards there. It doesn't actually take it back to the mean.
Does that raise the question that, given this very significant underestimate in terms of inflation this year, given all that's happening, there needs to be a rethink about how forecasting happens? Or do you think the current mechanism for doing what you're doing is fit for purpose?
No, I don't think it needs rethinking, but what I would say, and I'll speak personally now in terms of my own thinking about how I then use that in the interest rates decision-making processes, that I think the risks at the moment are larger and therefore have a larger certainly impact on my own thinking.
Sorry, Rushanara, very quickly, because it's on that specific point. So where the modelling, where you take the alternative modelling, where you take the future market price of oil and gas, etc., going forward after the 6 months, where today, what's happened to that curve, given what's happened in the Ukraine?
So,
how
that's
much has it shifted?
What's happened is that if we go back to November, the November MPR, I think I'm right in saying in November, we still had take gas prices, we still had a curve that actually came well down by this summer. Now, I think the way I would rationalise that at the time was that we knew that in Europe, gas storage levels were very low going into the winter. So there was a sort of story about a risk to gas prices in the winter, which was sort of amplified by having a low storage level. But then obviously as you come out into the summer, the price comes off, because you don't need as much gas, and you sort of hope that's the point at which I think they usually replenish the storage. Now, unfortunately, what has happened since then is, to your question, is that the curve has flattened in the sense that the prices further out have come up a lot. So that we now have a curve that doesn't really come off for 18 months. The last time I looked at it, which was earlier this morning. And so it has changed a lot. So I think I'm right in saying between November and February, the sort of the summary number for the movement in the relevant parts of the curve is about a 30% increase.
Would that mean that under the alternative model, the inflation expectations would actually now be higher than those where you?
Well, by the way, sorry, the February alternative model factored all of that in because it was the curve as in February.
I was thinking more about.
But what it means is that obviously the downside risk from prices coming off is being pushed further out. And just to finish, I think the only reason I can sort of really adduce for this is Ukraine.
Well, this chair read my mind.
Sorry.
So well, because I was going to come on to the last 24 hours and the fact that we've had the announcement with the German government and Nord Stream, the reliance on energy. Other colleagues are going to come in on the international perspective, but given the even greater external pressures. I suppose one of the challenges here is that we've already seen an underestimate in terms of forecasts. How are you going to stay ahead of the curve in terms of, rather than playing catch up, which is what some commentators, including some commentators have started to accuse the bank of being in a position of appreciating the context in which you're operating and some of the things you've said earlier.
Would you mind if I come in on that?
So can I just get the response from Governor, and then you're all very welcome to come in.
Well, it's very hard for us to forecast sort of geopolitical events. I mean, that's the real problem we have.
You saw it coming down the line. In fact, you've mentioned it in previous sessions, Ukraine and extant, geopolitical points.
And that's why we use market prices, because the markets obviously do, take on board that information. What we don't have is sort of, private information on what Mr. Putin may do next.
Yeah, but energy prices, and
the
reliance
market,
on Russian.
The market is full of professionals who are extreme experts on energy markets, who are paid to think about the developments in that market and what future prices will be. No one could have done better than that market, and that market was way off, miles off in what future energy prices will be. So if you go back, say, to the point at which monetary policy might have been able to do something about gas price inflation and its contribution to CPI. So given the lags that Silvana was talking about, to have offset this now, we would have had to have tightened policy aggressively in the summer of 2020. Okay, so that's the kind of time horizon you're talking about. Now, at that time, if you look at what the market was expecting the price of gas to be now, so I asked these experts...
It would have had to be done in 2020.
Yeah, but not only that, but if I asked them, they said, look at that market and see what it was predicting. The spot price of gas to be right now, the answer is something, I think, around 40 pence a therm, and it's now close to 200.
My question was touching
so we
on
don't
the current
forecast
context.
That's the point I'm trying to make. When you say, can you change the
it's
forecast?
Not a personal criticism of you. I'm trying to get you to reflect on.
But this is. I'm trying to answer the question specifically about should we change the way we do the forecast. And my answer is no. I don't think we can do better than to take the market price in general, whether that's, and we do it for the currency, we do it for oil, we do it for gas.
Okay.
And that is the answer to the question. So when you say, we don't forecast those prices, we just take what the market expects.
Okay, but there's a broader issue, and again, I'm going to play devil's advocate. You'll probably not be very happy about it, but I'm going to say it. There have been some commentators that are arguing that Threadneedle Street has fallen badly behind the curve, to quote, miscalculating the rise of inflationary pressures and now needs to play catch-up to regain credibility. Andrew Sentience, a former MPC, a committee member, is quoted to have said they've sent conflicting messages on monetary policy since last November, and they seem to have lurched from being very cautious to being seen to want to act, but it's still not clear what strategy they're going to be following in the future. So for all of you, do you feel that this is, that there is a strategy? Given all these external challenges, is it even possible, given we've, since the pandemic and all the Brexit shocks, we've got a £20 billion decrease in exports just in the last year, COVID, now geopolitical issues. And this is not about pointing the finger. It's about just trying to understand whether you feel that you've got everything in place to be able to respond to these really huge challenges. Silvana.
So, I mean, you're right, this is a huge challenge. And just to start from the basic, the most straightforward role for monetary policy is in offsetting inflation triggered by demand shocks. That is, shocks that push activity and inflation in the same direction. At the moment, as well as some demand-side pressures, the UK economy is facing a huge supply-side shock, as you rightly pointed out. And just to be clear, monetary policy can offset the inflation impact of a supply shock if hypothetically it knows about it well in advance, as Ben was saying. It cannot reduce the price of energy, but over time it can affect the prices of other goods and services so as to hit the target. Now, the reason that supply shocks are not straightforward and so challenging is because they create a trade-off for monetary policy. The increase in energy and tradable goods prices pushes up on inflation, but also lowers real incomes and real activity. And this creates a trade-off for monetary policy. Returning inflation back to target too quickly could destabilize economic activity and employment, reducing output below its potential and causing an increase in unemployment. So the MPC remit is contemplating very explicitly this type of trade-off shocks. And it recognizes that on occasion the inflation rate might depart from its target as a result of these shocks and disturbances. And in those settings, it acknowledges that attempts to return inflation to target might come at the cost of output volatility. The remit goes even further and acknowledges that in some exceptional circumstances, these shocks might be larger or more persistent or both, and in those cases, the MPC has to trade off, has to manage those and decide the speed with which it returns inflation to target, taking into account the cost in terms of output volatility. So the question for us now is how best to manage those trade-offs. And I mean, let me just add, these supply shocks are nothing new. In some sense, we were in trade-off territory with in the aftermath of the financial crisis and following the Brexit referendum. What is unprecedented, at least since in the latest decades, is the size of the shock.
Would it be appropriate to characterize what you're saying as you're basically backed into a corner with very limited, and given the external points, given all that's going on, with limited room for manoeuvre?
Well, we need to manage that trade-off, so it's in the best way possible, and it's a huge shock, and it's going to have a big hit.
I emphasise what Silvana said about the size of this. I mean, if you look at the increase in energy bills this year, it's just about twice as big as any single year in the 1970s. I mean, it is enormous, and that is the challenge. There's nothing we can do about that directly, but as Silvana says, we have to think about the horizon over which that shock peters out. And as for the strategy, I mean, the strategy is the same as it was when Mr. Sensence was on the MPC. It is, we have a forecast.
No, these people, when they leave, they get very vocal, don't they?
But that's my answer to the question, is what I'm saying.
So
I think it's the same.
But is the strategy fit for purpose still, given all that's going on?
Yes, it is.
Okay.
I mean, these shocks are enormous. They're the biggest, the MPC, even bigger than anything Mr. Sensence faced when he was on the MPC. And we have to manage them in a similar fashion.
He's not re-invited to reunion parties.
No, but I'm just saying that that I think is one of the key points to get across. And it is immensely challenging, and it sort of relates back to some of the things we were talking about earlier. We're talking about shares of income and shares of GDP. This is a huge hit to real national income. There's a question we were looking at earlier about, why is it that real incomes are weaker than GDP? And the reason for that is that real national income, doesn't happen very often, is much weaker than GDP because the prices of what we're consuming are going up much faster than the prices of what we're producing and selling.
Yep.
And that's the nature of this terms of trade shock. It's the nature of the huge rise in import prices. And that means there's a big squeeze on real incomes. And so we're facing the situation which is very clear in the forecast, where on the one hand, inflation stays high, not forever. But then on the other hand, domestic spending growth is weakening in the forecast, unemployment starts to go up, and that is precisely the kind of trade-off that policy has to think about.
Yeah.
But so in its nature, it's not different from what we've done, and I don't think the way we have of viewing it or forecasting or trying to manage it with policy should change, but the scale of it is completely unprecedented.
I did say I was being provocative.
No,
so
indeed, but I was trying to answer the
Jonathan
question.
Just to add, I mean, is the framework in our remit, which is contemplating those shocks. I guess it's the size that is extreme.
Just one small thing, if I may, just to complement Ben's remarks about the scale of it. The share of energy, oil, gas and so forth, in the whole consumption basket is only 6% of the consumption basket.
Yeah.
But its contribution to the rise in inflation over the last year is almost 50%. So just a 6% share gives you explains almost half the rise.
More than that in recent months.
But that data was, for the record, was for the rise over 2021. Indeed, Andrew, I should say that.
It's about 70% in January, we think, in the sort of first quarter or so of this year.
So wouldn't it, given this tight spot you're in, with inflation being basically way off target and it's going to continue to go up, isn't it the case that this is something where you've got limited scope in what you can do, and it requires policy intervention by government if we want to do anything to address the pressures, the energy price pressures on consumers? There's not really a great deal, is there, that outside of policy that can be?
That's for government to answer. Sure. What I would say, however, is that as I think all of us have said during the last period, there's nothing you can do to lose. This shock can't be hidden away somewhere. It's a shock to national income. So it's not for us to say what government policy would be, but I would simply observe that there isn't a public policy that can lose the impact of this. In that sense.
Yeah, but you're not. I suppose what I'm saying is you're very limited in what you can do here.
If I can come in, if you'll forgive me.
Sure.
I mean, we're focused. Our job, our remit, given by you, is on the average inflation, is on the inflation rate, the average inflation rate. Now, you're absolutely right, and Andrew was saying this earlier on, that changes in inflation affect different people at different stages of the income distribution, retirees, non-retirees, and all that kind of thing. But that's not something for us. Although it's obviously very important that campaigners have
since the governor opened up
the
the conversation about wages and the earlier conversation, I suppose I'm taking it as permission to be able to give for us to think more broadly about the role of where government. I'm not saying you should. I'm not asking you to recommend to government that this is an issue that's exercising all of us in terms of the impact on citizens. And that actually, that's an area that government needs to address if it wants to do anything through policy to try and take the edge off the pressure on consumers in terms of inflation and fuel price increases.
I say this as an observation, not as a piece of advocacy, because it isn't. I think I observed at the last hearing we had that if you take the household survey and split it into deciles by income, the lowest, the bottom decile, I think, spends around about 7% of its income on energy.
Exactly.
Yeah.
That's around about twice as much as most of the other deciles.
Yeah.
There's a really break in the number at the bottom decile.
Not literally violent, but violent reaction to the comments about wages, because people are feeling the pressure on the cost of living.
But that's my concern.
So
Look, just to reiterate what I said, is my concern is that in a second round inflation effect process, it's those who have least bargaining power in the labour market who get hit more
Yep.
And just to add the observation I've just made, and by the way, because I'm afraid it would be concentrated more at the lower end of the distribution. They're spending more on energy.
We
can't
I've got a
upset
couple of questions on interest rates.
So I can observe it, but I'm afraid we can't. Obviously, we haven't got the tools to.
Sorry, Silvana.
Yeah, just related to this and going back to Dame Angela's questions, the Bank of England doesn't have any influence on how workers and firms share the losses or gains. And if workers want to negotiate higher real wages at the expense of profits, that's completely independent of monetary policy. Where monetary policy steps in is when it sees wages and domestic prices accelerating together. And that's our, the role in which distributional issues are for government.
Yeah, no, absolutely, and we'll move on. We'll move on to interest rates. So we've had ultra low interest rates for the last 13 years, but with inflation soaring, are we going to see an end of an era with ongoing interest rates for some time to come? To increases for some time to come. Perhaps I'll start with Ben.
I don't know. I mean, I doubt we're going to get back to the levels we had in, certainly the levels when the MPC first began in 1997, still less those that prevailed earlier. Ultimately, what's required in terms of the level of interest rates depends on, we've used this technical term, the equilibrium real rate, set really in global markets. That has definitely come down over a period of many, many years. I would argue in this country it's been going on globally actually going on for at least a quarter of a century, that process. And our understanding of the sort of things that have probably driven that decline is that they're unlikely to turn around very dramatically. They may at some point. And nor are they really connected with what the inflation we're seeing right now. We've spent a lot of time talking about energy prices, other prices of other global traded goods. A lot of that's connected with the pandemic. It's not really done anything to change my view about those longer-term factors. Now, we have said that we think we're going to need probably some further gradual and limited rises in interest rates to ensure a sustainable return of inflation to target in the medium term. But I don't think that means some inexorable and never-ending rise back to the kind of levels that prevailed before. I think that's pretty unlikely. So we don't pre-commit to some level. We don't say, this is where we're definitely going. But if you ask me to guess beyond, we can talk only in very broad terms, I think it's pretty unlikely that interest rates will have to go back to those sorts of levels that were there, 20, 30 years ago.
Yeah, but what should we, people have got used to having low interest rates.
Yes.
So what do you think is likely to happen in terms of the impact on the way that people have experienced it, whether it's mortgage interest and so on, and how that impacts on the wider economy?
Well, we spend a lot of time thinking about how policy works, obviously. So I don't see any particular reason to think that these changes will have dramatically more impact than a change would have done, 2, 3, 4, 5, or even 10, 15 years ago. And in fact, if anything, with reference to some very specific channels, like, say, the mortgage market, actually the process is likely to be slightly slower and more moderate in the first instance, partly because there's you've got to remember that fewer than half of households have a mortgage. And B, those that do, there are many more fixed mortgages amongst that population. They're not fixed for 10 years, but they're certainly fixed for 2 or 3 years. And
households and businesses who've relied on low interest rates shouldn't have such unexpected surprises or large rises.
There will be some. And on the other side of the other committee to which Andrew and I belong, or one of the others, the Financial Policy Committee, spends a lot of time thinking about the tail of the distribution, and those for whom debt costs, whether it's mortgages or corporate debt, form a high proportion of their income. And there may well be some increase in that population, but overall, and the MPC is certainly concerned more with the overall, I don't think, my own view is that we'll see, but the necessary rise in interest rates will be so dramatic that it takes us back to the levels that prevailed, as I say, 20 or 30 years
It's
ago.
not going to be dramatic. What sort of numbers should...
Well, I'm not going to give you a number because we will do what is, the important thing, coming back to Silvana's remarks about the remit, is that we do what is necessary to ensure a sustainable return of inflation to target over the medium term with least real cost to the real economy. And, we've talked a lot about the unpredictability of the shocks that come along. It's crucial to remember that our job is to respond to those shocks in as much as they affect our projections for the medium term. And so to pre-commit to some level of interest rates would be the wrong thing to do in the face of all these shocks that come along.
No, I appreciate that. But given the way in which inflation's kind of come as a big shock, I suppose what I'm getting at is people will want some reassurance that, they're not going to see very high levels of interest.
Well, I've tried to give as much as I can, but I can't what I'm saying is I can't say here's a number beyond which we will never go.
So as Ben says, we can't pre-commit to a level of rate. And what I can say is that the best thing is to look at our forecast and the updates of our forecast. So currently, our forecast suggests that if we kept interest rate at 50 basis points indefinitely, that would create an overshoot of inflation in year 2 of 60 basis points, year 3 of 10 basis points. So that suggests that some more modest tightening, and really modest, would be needed to return inflation to target over the forecast period. So that's the range of magnitudes as of now. But of course, there is a lot of uncertainty around that, and Ukraine, as we just talked, is one big factor that might play out. Now, just to remind, just before the pandemic, rates were at 75 basis points, inflation was below target, and unemployment was very low. Labor market was tight, at least in quantity metrics, if not so much on the wage side. But so many things have changed since then. But not dramatically, as Ben said, nothing structural to change significantly in my view, at least. But again, it's important to keep the uncertainty that we cannot give a concrete.
Thank you. I don't know, Governor and
I was thinking actually at the moment Silvana's actually said most of it. I was just going to repeat the words that we used in the monetary policy statement, which is further modest tightening is likely to be appropriate in coming months. And that's the position.
Coming months is the point, isn't it? People are thinking what's going to happen next year and the year after. But I appreciate what you're saying.
I mean, I think I said in the press conference we held when we issued reports. I mean, I would just repeat those words because it is a message to markets not to get carried away. I mean, it's the same message that Dave Ramsden gave in his speech yesterday.
Okay. Jonathan, did you want to?
Nothing to add.